about general VIX, because even as equities have had some spotty patches in the rally off the low, it's been pretty consistent, but it's been even more consistent in VIX. It's just been dropping like a stone basically since the VIX high in mid-March, Jermal. So what's it telling us?
Yeah, it's interesting. I mean, we were last here, what, March 25th, so near that peak panic area. And long vol and long gamma is really what's been working as far as trading has gone over the last month or so. But global index volatility, like you said, it has come in meaningfully. I mean, but you have to keep it in perspective. I mean, we're still looking at a VIX at around a 31, 32. 32 means 2% daily moves on the SPX. So yeah, vol has come in meaningfully, but look at what's happened. I mean, the unemployment has gone from 3.5% decade lows to now close to 15%. We'll see what that number is like next week. Fed has dropped rates from 2.5% to 0%. Gold has gone up 30%. Oil is down 70%. And yet with all of that, when you look at where the market is today, we're down 10%. So it's pretty interesting what has happened during those time periods. I mean, there's a lot that's been going on, right?
Jermal, does it seem like this thing's just going to keep going until we get back to more historical ranges? I mean, a lot of times 30 is an area that is kind of like the peak of a sell-off. I mean, obviously it depends, but the idea here is, what's the regime? Is 30 VIX going to be our floor? Is 15 VIX? Is 10? I mean, clearly there's no way to know that, but what do we kind of expect given the historical nature of what happened? Are we just completely at the mercy and whims of the market, or is there any backdrop here in history we can look at?
I mean, we're in no man's land. I mean, it's interesting because when you look and see, when I was last on, 10-day realized volatility on the SPX was 118. Today, it's around a 34. We'll see yesterday was a 34. We'll see what it closes at today. A week before that, it was at a 44. A week before that, it was at a 50. So, I mean, we've seen how things have moved around. And when you look at VIX right now, when you look at what's going on, the term structure is in backwardation, but it's kind of flat across the range. And so really what that's showing you is that virus data, and a lot of the data that we're going to get out of these reopenings is what's really moving the market currently. So we really have no idea. I mean, we know Q2 earnings are going to be terrible. We know that that's going to come. What is it going to look like going further out? And I think that's the thing that's hard to figure out for the time being. So I think that's why you're going to see VIX still at this is still considered elevated level, people. Don't forget, VIX 30 is, not anything to sneeze at. So like I said, I mean, VIX 32 is 2% daily moves. And so the reason why you get that is basically when you take the square root of the trading days in a year, which is 252. So let's just call it 256. Square root of that is 16. When you divide that by the VIX number, that's how you get the move. So 32 divided by 16 is 2% daily moves. So that's where we get that from. And so I think what you're going to see for the time being is VIX is going to stay at this elevated level until we get some news that says, contractions aren't happening as much, or just, I think it's really driven by virus data right now.
And right now, those 2% moves are largely happening to the upside, of course, over the last couple of weeks. Jermal, is it a painful environment for those who are owning options and have exposure to the VIX that is basically decaying right now? I mean, if you look at volatility at 30, and traditionally you might say, okay, this is an environment where volatility is elevated, but when we keep dropping every day, I imagine you really have to be able to hit your mark when you're trading. I mean, you really got to hit it on the nose, right? If you own puts or you own calls, regardless, if you're the owner of volatility, does it make it tricky?
It makes it tricky, but kind of like what you said, you almost have to hit it on the nose in a way. But however, yes, you're correct in that the volatility coming in is painful for option owners. However, options have been moving, or I should say stocks have been moving. And so you're getting that move often to be able to monetize the option that you own, whether it's calls or puts. Now, that doesn't mean your option can't move away from you. You could be long some calls one day on something that moved up 3%. And if you didn't take that gain, it could equally move down 3% or 4% the very next day. That's the kind of movements we're getting in stocks. So you have to monetize your option currently. And so, like I said, long gamma, long vol has been working. If you're long options, it's been a good thing for you. But if you haven't capitalized on closing out your option ahead of time before the move on the opposite side, well, then you lose. And that's not necessarily because of volatility. I should say directly, that's just more because the move has happened against you. So you've been able to monetize the moves that have happened with long options. And, I think it's been beneficial for people being long options currently.
What is the futures curve right now for VIX tell you, Jermal? We were just looking at it. I mean, it's basically a straight line down, where it's a pretty unique looking situation. Normally, this thing slopes upward, and you say, okay, the volatility in the short term is a little bit more peaceful. In this case, it still looks like, according to what this is pricing in, basically is a return to normalcy. So I guess barring some unforeseen surprises, we should just expect us to slowly get back in line with the more type of contango shape that we're used to?
Yeah, I mean, it depends on, again, it depends on the virus data. And so right now, what it's telling me is that you can expect some volatility, at least for May, June, and maybe July. It depends on what these reopenings look like and how our process is for that. But that's what you're seeing right there. And then it's also interesting to see that kink in October come back. The October elections volatility has come back into place to some degree. So you are seeing somewhat trying to return to that level, but you see it's very flat across the front part of the curve. I think those are within 50 to 70 cents of each other. So there's not much difference for the next 3 months. And that's probably true, right? I mean, we don't necessarily know when we're going to fully come out of this. We're going to come out of it in stages. And I think that's what you're seeing right now. So it's pretty clear.
I like this point that the election vol had basically been invisible when the whole curve got pushed up so much during the peak selling. Now it's kind of reappearing a little bit. You can see that tick up there. It's still not as sizable as it used to be, but it's there. So at least that feels a little bit more normal, that maybe there's some volatility around politics again. Jermal, let's talk what's been happening small versus big cap. Small cap VIX, RVX, and you look at it next to either just VIX, or if you put it next to the NASDAQ, it was very clear that there was something going on here. And now it looks like maybe it's trying to get back to some degree of normal. This is pretty fascinating. What do you think?
Yeah, there's been a lot of talk about this over the last, I'd say 10 days or so, 10 trading days, maybe almost 2 weeks. This idea of this big divergence, as you guys have here, between RVX and VIX. Of course, RVX is the volatility measure of the Russell 2000. And you could see this big divergence between them. I think they decoupled originally around the 27th. The Russell 2000 and SPX decoupled originally around the 27th of March. So 2 days after you and I originally talked, because prior to that, everything was a correlation of one. Everything was basically moving in the same direction. And at some point, once we got the Fed throwing a lot of money at either munis, the municipal bond market, or the high yield bond market, not to mention the whole entire market, the SPX started to move up. Small caps were still down to some degree. And I think that's why RVX, the volatility of Russell 2000, remained elevated more so than the VIX. And over the last 4 days, we've seen a big move in small caps. And we've seen the reason why. We've seen those Russell 2000 stocks move up. We've seen volatility come in the RVX. But typically, you will see RVX trade at a premium to VIX. It was just a huge premium 2 weeks ago. We've seen that come in to some degree.
Given that the strength was even more pronounced on the way up in the NASDAQ, if we look at RVX and the spread to VXN, the NASDAQ VIX, you clearly see where that spread got way blown out. Now it's trying to get back to something normal. Jermal, do you see people taking advantage of this? We've had a few guests on our show that have mentioned this as well, basically saying, look, you can take advantage of the way NASDAQ had moved to such a degree by buying some of the NASDAQ vol and selling the Russell vol and kind of playing the two against each other.
Correct. And, again, that gets back to this correlation theory where when things are moving together, when the names are moving, the same as the index, or everything's sort of moving in the same direction, you can look at an opportunity to take advantage by selling that index vol and then buying the components. And I think, and I could be wrong, but that trade is probably slowing down a little bit for the right now as we've entered this realm of, I'm not sure exactly where NASDAQ is, but SPX being 2,900. I mean, that's a decent sized level. That's not too far from where we were at the end of the year. So, I mean, I think the end of the year was around 3,200 or so SPX. So we are in a no man's land right now, I like to call it, because we're not sure if we're going to go up another 100 handles or back down 100 handles. What will be the driver of that? I personally don't think it'll be earnings. I think it's virus related data. We know earnings are going to be terrible. We also know economic data is going to be terrible because of what we just came out of. So going forward, what's it going to look like? I think you're going to start seeing some people unwind a few trades. You and I talked about this a little bit yesterday. We saw a big unwinding in the NASDAQ yesterday, even though we have these 5 big guys that are going to present starting today with Google. You saw a little bit of that unwind. You saw a little bit of profit taking with the NASDAQ names, and they rolled that into the small cap names. We'll see what happens today, but so far it might be the same type of trade. I know some NASDAQ names were bid going into the market open here, but Russell 2000 is already up 4%, close to. So we'll see. Well, I'm sorry, 3%. So we'll see what happens today. This is a great market to trade in. I mean, there's a lot going on, right? It's an interesting time. Oh, big day. And maybe we'll see what happens if the window cleaners at your place, if they'll show up. I mean, I don't have any. I just have a normal background here, but you always have some cool stuff going on in your house. So, maybe we'll see what happens with that.